Here's the script rewritten in simple, friendly storytelling style. Trading was halted, orders were canceled, the screen basically went completely dark. And when the market finally came back online, the pressure had mysteriously just vanished. Now the exchange will tell you that this was procedural, a technical decision, a glitch, nothing to worry about. But if you were trying to prevent a delivery squeeze without formally declaring a default, it would look almost exactly like what just happened. So let's take a look. To be clear, this is not a default story. It's more about credibility. And in this video, I want to show you why this halt matters far more than the headlines have been suggesting. Because if you're relying on COMEX pricing to manage real wealth, you need to understand the difference between a market that clears through price and a market that is surviving by managing time. Welcome back to Goldcore TV, where we bring you real people with real opinions talking about real assets. I'm Jan Scoyles, and today we are looking at the structural signals and cracks that just appeared in the silver market. Let's start with signal number 1, what the open interest was actually screaming at us. In the days leading up to the halt, open interest, meaning the total amount of ounces that participants are contracted to exchange in silver, was elevated. It wasn't at historic all-time highs, but it was high enough. And crucially, it was sticky. Now usually as a contract approaches expiry, traders roll over their positions. They move from the front month to the next month, and the pressure on the physical delivery mechanism dissipates. That's a healthy market functioning normally. In simple terms, this means that they close their position in one month and open up again in a later month, avoiding the need for the delivery of any metal, but still maintaining exposure to the price movement, basically a perpetual "can I pay for it later?" But like I said, that is a healthy market functioning normally. But this time, that roll was slow. A significant number of contracts were just sitting there, seemingly waiting for something. If a larger than usual number of investors decided to stand for delivery, the pool of registered metal available to satisfy them was looking dangerously thin. And this is a classic setup for expiration stress. In a textbook commodity market, this imbalance resolves through price. The price shoots up until sellers are enticed to sell, or buyers are forced to walk away. The market clears by finding a price that balances the greed and the fear. But that is not what happened here. What happened was the market stopped, and when trading resumed, open interest had declined sharply. The immediate upward pressure had subsided. So just think about that. The problem wasn't solved by price discovery, it was solved by interruption. Time was created for participants to step back, make some phone calls, and redistribute exposure. And what does that mean for you? If you are trusting the all-clear signal from the price chart alone, you are really missing the reality here, because the pressure did not disappear. It was just deferred. And if you're timing entries or hedges, you are now operating in a market where the referee can stop the clock whenever the home team gets tired. So this brings us to signal number 2, which is the timing. This halt didn't happen on some random Tuesday in the middle of a quiet month. It came right as delivery decisions were becoming urgent, and this is the moment of truth in futures markets when longs must declare "I want the metal" and shorts must confirm "I have the metal." Now in a credible system, this moment is kind of sacred. It is the mechanism that tethers the paper price to reality. Now instead, we saw a sequence that prioritized system survival by pausing trading and canceling orders. The exchange effectively cooled the room down. Now we have to be fair here. Exchanges have circuit breakers for a reason. They need to prevent disorderly collapse. But there is a very fine line between preventing disorder and preventing a valid price spike. The crucial distinction I want you to learn today is the difference between price clearing and time management. Price clearing. It can be painful, but it's an honest thing. Time management is painless, but it's deceptive. By managing time, they've deferred the imbalance. They provided breathing room, but for you, the physical silver holder, this is a red flag. It suggests that the price you see on your screen is being managed to protect the shorts rather than allowed to run to reward the owners of the real assets. Now signal 3 is about margin policy and the compression of leverage. In the weeks leading up to this event, we saw adjustments in margin requirements. This was standard practice when volatility increases. The exchange asks traders to put up more cash to hold their positions. But consider the combination here. Open interest is sticky, delivery pressure is building, and suddenly it becomes much more expensive to hold a position. This acts as a soft cap on the price. It forces the smaller leveraged players out of the market. It cleans out the speculators who might have driven the price higher, leaving only the massive institutional players who can afford the new table stakes. What the system appears to tolerate least is not high prices, but acceleration. The system can probably handle silver at $90 or $100 if it gets there over a couple of years. But what it cannot handle is silver jumping $5 in 10 minutes, because speed forces immediate delivery choices. Speed breaks the just-in-time delivery chain. Now for wealth holders, this tells you something vital about the environment. We are in a structurally constrained market. The plumbing, if you like, is fragile. It can't handle velocity. And a market that cannot handle velocity is a market that will eventually break when a real catalyst emerges. And this takes us to signal 4, which is perhaps the most concerning for the long term. And this is the vault disconnect. Now we tracked the difference between registered and eligible silver vaults in previous videos. Eligible means it's there, it meets the purity standards, but it is not currently available for delivery against a futures contract. It might be owned by a private investor who has no intention of selling, for example. Now, registered is the metal that is actually available to settle the bet. Historically, when prices rise, you expect registered stocks to refill. High prices should tempt the owners to sell their metal into the market, but we aren't seeing that replenishment happen at the scale that we used to. The registered category remains stubbornly thin relative to the paper claims outstanding. Now, what this tells us is that the owners of physical metal are becoming less willing to part with it, even at higher prices. They prefer to hold the asset rather than the cash. And when the price rises but the warehouse doesn't refill, well, you have a broken feedback loop. It suggests that the paper price isn't high enough to unlock the real metal. And that gap between the paper price and the price required to actually get metal is where the real crisis will eventually originate. So that brings us finally to signal number 5, which is the migration of trust. This episode cannot be understood solely by just looking at New York. Because silver trades in London, it trades in Shanghai. It's a global asset. Now, under stable conditions, these markets are connected by arbitrage. If silver is cheap in New York and expensive in Shanghai, traders buy here, they sell there, and the prices align. But when you have halts or order cancellations and margin hikes in the West, well, that arbitrage becomes risky. Traders stop trusting the mechanism. If I'm a global trader and I see that COMEX might cancel my winning trade or halt the market just when I'm about to get paid, why would I trade there? I wouldn't. I'd just move my business elsewhere or stop trading paper entirely and just buy physical bars in a private vault. And this is the migration of trust. We are seeing early signs that pricing authority is shifting away from the paper-centric West and moving toward markets where physical delivery is the norm, not the exception. So if this trend continues, the COMEX price becomes less and less relevant. It becomes a kind of zombie price, a number on a screen that doesn't actually represent the cost of getting real metal into your hand. But let's bring this back to you and your portfolio. We are not saying that the COMEX is going to default tomorrow morning, because the system has so many tools to keep the game going. Halts, margin hikes, cash settlements. They can manage time for a lot longer than you might think. But as an investor, you have to ask yourself, is this a benchmark that I want to bet my financial future on? If you are holding paper ETFs, then you are essentially renting exposure to this plumbing. You are betting that the circuit breakers won't trip exactly when you need to cash out. Now at Goldcore, we look at this data and we draw a pretty simple conclusion for our viewers. Don't expect paper to treat you the same as physical silver. The only way to insulate yourself from a time management crisis is to own the asset outright. Own physical metal. Own it in your name, allocated and segregated. Store it in a jurisdiction that you trust and that respects property rights outside of the banking system. When you own the physical bar or coin, a COMEX halt is just noise. It's just a news story. It doesn't freeze your wealth. In fact, it pretty much validates your decision, because it proves that the paper system is struggling to deliver the very thing that you already have in your vault. So if you want to find out more about this whole COMEX scenario, click on one of these videos to find out more.